Right. We were discussing about credit risk, and we did up to the 26th question. So we'll start with 27 today. Now the polling is not yet ready, so we will use the chat box. Right. I've got responses. All are saying C. Let's see what the question is. Which of the following is the primary risk if an institution decides to make a large corporate loan? I think you don't need to worry too much. It's obviously credit risk, right? In fact, we are discussing the credit risk. So it's C. All of you have given the correct answer. We started with an easy one. So the answer is C. Right. C. Let's go to the next question. I'll get the polling in a while. Right. Only 2 people have responded up to now. And still I have got only 4 responses. Let me see what the problem is. Is it a difficult question? Let's see. Right. The question is, an organization A owes 10 million to B and 2 million to C. B owes 7 million to A and 5 million to C. C owes 2 million to B and 9 million to A. If payments between counterparties were netted, what would the result be? Right. So netting. So we need to draw this. It will be easier. Right. Let's say A, B, and C. A owes B 3 million. A to B 3 million. A owes A owes B 3 million. Who owes C 3 million? B owes C 3 million. Who owes A 7 million. So C owes A 7 million. Then a different color.
Question is A of 10 million to
A owes B. Sorry. I must look at the question, right? I have taken the figures from the answer. Let me see this. Sorry. A owes 10 million to B. A owes 10 million to B. And 2 million to C. Right? 2 million to C. B owes 7 million to A. B owes 7 million to A and 5 million to C. C owes 2 million to B. 9 million to A. Right. Now the net. A and B, if you look at, A owes 10 to B, B owes 7, so net 3. A to B 3. And here 3, B to C 3. And here 7, C to A 7. Right? A to B 3, B to C 3, C to A 7. Right? This is the one. So the correct answer is A. Right? I have only got 6 responses. Oh yeah, now I got 7, 8. So most of you have given the correct answer. Right. Let's go to the next question. 29. Right. We've got 9 responses out of 17 participants, 16 participants. What's the question? Which two are consistent parts of credit exposure? Potential future exposure and default exposure, default exposure and rating exposure, current exposure and rating exposure, potential future exposure and current exposure. So the question is, constituent parts of credit exposure. Credit exposure, it's about credit exposure, right? What do you consider as credit exposure? So the credit exposure is, you look at the amount of loss, right? Or the potential loss if a debtor defaults. So that potential loss of default is a result of current and future exposure. Current and future exposure, not the past. So the correct answer is D. So 7 out of 9 respondents have given the correct answer. Let's go to the next question. 30. And I've got 6 responses. Right, I've got 9 responses. Let's see what it is. Let's go fast so that we can finish more questions today. Right. Okay. The question is, A is due to pay B 8 and receive 12 from B. A is due to pay C and receive 14 from C. B is due to pay C 14, receive 10 from C. But it's a combined effect of the transaction when all are paid to the central clearing house under a netting agreement. Okay. We need to do the same exercise what we did before. Right. Let's see. We have A, B, C. A is due to pay B 8. And receive 12. From B. A is due to pay C 8. And receive 14. B is due to pay C 14. Receive 10. Right. So let's see the netting. 8, 12, 4 this way, 14, 8, 6 this way, 10, 14, 4 this way. So B to A 4, B to C 4, C to A 6. Right. Now the difference here is that instead of paying ABC, like in the previous case, each of them have netting arrangement among them. So now in this case, you are going through a central clearing agency, therefore you will not directly pay the other party. Instead, you get the net amount into your hand, right? Or if you are supposed to pay, you are supposed to pay that amount. So in this case, A is supposed to receive 4 from B, right? A is supposed to receive 4 from B plus 4 and 6 from C. So altogether, A is supposed to receive 10 plus 10. If you look at B, B is supposed to pay A 4, B is supposed to pay C 4. Altogether, B is supposed to pay 8 net. Then the C is supposed to receive 4 from B. C is supposed to pay 6 to A. So it's a minus 2 for C. Right? I hope you all understood the calculation I did. So which one gives the correct answer? This one. Right? So the correct answer is C. Only 2 people out of 10 have given the correct answer. I hope you all understood the logic what I did. Right? Do you need me to do it again, or are we clear?
Clear.
Clear, right? Okay. So there's a difference between the previous one and this one, right? Previous one, they exchange them among themselves. Now we go through a clearing house, then you look at the net position. So the correct answer is C. Right, 31. Right, I've got 9 responses. Let's see the question. All of the following are methods for managing credit risk within a portfolio except, right? Diversification, netting asset, securitization, credit derivatives. We discussed similar things last week as well. So the correct answer is netting. All others are portfolio level. So it's B. Correct answer is B. Yeah, some of you have given the correct answer. 32. But I've got 11 responses. Let's see the question. Which of the following investments contain the least amount of credit risk? Buying shares in company XYZ PLC for settlement in 3 days' time. Entering into an off-balance sheet transaction with PQR Bank PLC. Holding US Treasury bonds with a short-term maturity. Holding medium-term bonds issued by XYZ PLC. So the question is about which one of these contains the least amount of credit risk, least, lowest risk. So it's the government security. Right? Government security has the lowest amount of default risk. So the correct answer is C. 8 out of 12 have given the correct answer. Let's go to the next question. 33. But I've got 9 responses by now. Let's see the question. Which of the following does not provide resources for the use in the event of default by a member of a central clearinghouse? Does not provide resources for use, right? Exchanges, clearing members of the clearinghouse, regulators, bank acting as underwriters. I think you must realize, even if you have little knowledge about these things, the question is about which of the following does not provide resources, right? That means bailing out, right? That's the regulator. Regulator doesn't provide resources. Regulator monitors only, right? Others will support in different ways, but the regulator will not provide resources. So the correct answer is C. Some of you have given the correct answer. But I've got 10 responses. Let's see what the question is. Right. The analysis of a counterparty's financial statements prior to trading with them is the responsibility of the accounting function, audit function, credit function, compliance function. I think it's clear. So when you deal with the clients, none of these other functions will get involved in the operational activities. So this is a activity that should be carried out by the operation. That's the credit function. So the correct answer is C, credit function. So 34C. Let's go to the next one. But I've got only 5 responses. Right, let's see the question. Which of the following is the best description of a credit default swap? Credit default swap. Protection seller pays a fee to a protection buyer in exchange for a contingent payment if a credit event occurs in relation to a reference asset. Right? An investment bank issues high-grade notes, the coupons of which are enhanced by the sale of credit protection. C, an investment bank agrees to pay the coupons and capital gains on a reference asset to another party in return for regular LIBOR-linked payments. D, a protection seller receives a fee from protection buyer in exchange for a contingent payment if a credit event occurs in relation to a reference asset. Now, the battle is between A and C, A and D, right? The C and D are obviously not the answer. So then, right, a protection seller pays a fee to protection buyer. Protection seller pays. Why should the seller pay a fee? A protection seller must receive a fee because they are the party providing the protection. Protection seller receives a fee from a protection buyer, right? So in the event of a credit event, the seller must compensate that. So the correct answer is D. Yeah, out of the 5, 2 have got the correct answer. 36. But I've got 11 responses by now. 36. Right. Which of the following is a means of reducing credit risk within a portfolio? Again, we're looking at portfolio. Hedging, top slicing, diversification, equalization. So don't worry about the terms that you are not familiar with, but you know one for sure. So we've discussed the relevant ones, that is in a portfolio. So diversification is a portfolio level risk mitigation mechanism. So out of the 11, 8 people have given the correct answer. It's C. Let's go to next one, 37.
So why not it's hedging?
Sorry?
Why not it's hedging? Hedging?
Hedging is not a portfolio level. Hedging is individual. Acceptable.
All right, right, okay.
Right? So portfolio, they're asking. But I've got 8 responses by now. Let's see what the question is. Which one of the following are objectives of an efficient or optimal portfolio? Provide the highest risk for a given expected return. To eliminate all downside risk. Provide the greatest expected return for a given risk. To provide the greatest upside benefit. Yeah. You can see we discussed what an efficient portfolio is. In that, you're getting the highest possible return for a given amount of risk and the lowest possible risk for a given amount of return. So those two are the key features. So in this case, based on the given information, answer C gives you one of them to provide greatest return for a given risk. So it's C. C. Let's go to the next question. 38. I've got 9 responses. Let's see. Which of the following is not a responsibility of the credit risk management function? Right? Not. Ensuring the credit policy is adhered to, setting, monitoring, and reviewing credit limits, determining the minimum level of capital adequacy, reporting and escalating risk issues to senior management. Yes. So determining the minimum level of capital adequacy is not a function for the credit department. It's a different function. So the correct answer is C. So 39. And I've got 9 responses. Let's see what the question is. Which of the following is not a method of mitigating credit risk? Not credit derivatives, credit limits, netting, specialized portfolios. Right. The question is about not a method of mitigating credit risk. Right. So out of the given list, except the last one, other methods are mitigation measures. Right, ABC. So the correct answer is D. Right, correct answer is D. 39 D.
So what is the meaning of credit derivatives?
Derivatives we discuss, if you can remember, derivative is something that we have based on an instrument. You have another instrument, the value of which is derived based on the underlying instrument. So the basic example to understand derivatives is a permit, vehicle permit. Vehicle permit is a derivative, because the value of the permit depends on the tax benefit you get, and it's attached to the vehicle, right? So depending on the price of the vehicle, the permit will have a different value. Likewise, a derivative is such. So in a credit instance, when you have credits, you can have a derivative as an instrument to mitigate the risk of the credit or the loan. So we discussed several things. So the even credit default swap (CDS) is a derivative. That means you have an arrangement with another party. When you have a risk event, you'll be compensated by the party. So the swap is a party, it has a price separately. Right. If you go back to the discussions, you can figure out that. We discussed those. Okay. Right. So there is, okay, someone has asked a question. What is this? Q38D is not about credit risk. Isn't the answer is D? What is that? Which of the following is not a responsibility of the credit risk management function? So why D? Reporting and escalating risk issues to senior management. Isn't it a responsibility of the risk function? It is a responsibility of all the risk function, not only credit, right? Operational risk, market risk. It's a function. So the question is not a responsibility of a credit risk function. Therefore, the answer is C. Right? Okay. Let's go to the next one. 40. But I've got 8 responses. Let's see the question. The clearinghouse uses all of the following to protect itself against the risk of default in relation to exchange traded deals, except position monitoring, initial margin, membership controls, client credit worthiness, guarantees. Yes. In the given list, client credit worthiness guarantees is not a function of a clearinghouse. That is someone else. You won't give guarantees. You do the clearing, admin work. So the correct answer therefore is B. Few more to go. We'll quickly go. 41. But I'm waiting till I have responses, but let's go in the interest of time. So let's see what the question is. A broker fails to deliver a bond issued by a good quality company that is currently paying its coupon and redeeming its bond. This is an example of which type of risk. So broker is failing. Concentration, issuer, impairment, counterparty. So it's the counterparty risk. Yes. Except one, all of you have given the correct answer. It's D. We'll quickly go. We have two more to go. Quickly go. Right. 42. But I've got 7 responses. Let's see what the question is. Which of the following is not a method of arranging collateral? Right? Collateral. Unilateral, consented, netted, bilateral. Right. So in the given example, the situation, so what is a collateral? Collateral is something that the lender, whoever is giving money, is arranging for his security. So it can be unilateral, one-sided, right? It can be netted. Netted is also a method because so that you get a net amount. Bilateral. So the correct answer is consented, right? Consented. So you don't need to wait for the consent and arrange it, otherwise you will not be able to arrange it. So the question is about not. So the correct answer is B. Right? Some of you have given the correct answer. Right, the last question, we'll finish that also. Right, almost everyone is giving the same answer. Let's see what the question is. The BIS recommends that banks could carry out stress testing for each of the following areas apart from which one? Liquidity conditions, market risk events, impairment provisioning, interest rate movements. Yes, all of you have given the correct answer. The correct answer is C. Right? Question number 43. C. Right. Right. Good. So we have completed that paper as well. The next is market risk. Let's take a break now. After the break, we'll start the market risk. Right. I think most of you are back. As I discussed before the break, we are now discussing the credit risk. Let's start with the question number 1. Sorry, we are starting with the market risk. Right. Let me launch the poll. So, can the host, can you make me the host, please? To launch the poll. So, whoever is logging from the academy, please make me the host.
Okay, sir.
Right. In the interest of time, let's look at the question. Which one of the following tools is used to ascertain the relationship between variables? So relationship between variables. Regression, historical loss analysis, sensitivity analysis, distribution analysis. Right. It's about relationship between variables. Right. So those relationships we look at in the first one, regression, right? Regression. We look at the relationship between two variables and we calculate the correlation coefficient. So the correct answer is A. Right. Right. Let's see, 5 people have responded. Let's see the question. In a normal distribution curve, the percentage of data that will be within 2 standard deviations from the mean. We discussed 1 standard deviation, 2 standard deviation, and 3 standard deviation. So 1 standard deviation is 68%, 2 standard is 95%, 3 standard is 99%. So the correct answer in this case is A, 95%. Right. Question number 3. Right, only 4 people have responded by now. Let's see the question. Which one of the following would be used to compare actual daily trading losses to the predicted value at risk figure as a measurement of market risk? Actual versus predicted. We discussed this, right? So regression, historical simulation, stress testing, back testing. Yes, the correct answer is back testing. 3 out of 4 respondents have given the correct answer. Question number 4. Right, I got 6 responses this time. Let's see the question. Which of the following would be generally be used to mitigate market risk? Launching break clauses in contracts for certain circumstances. Limiting size of the loss the trader is able to make on a transaction. Using legally enforceable documentation requiring close-out netting. Taking collateral from counterparties promptly. So the question is about market risk, right? Not credit risk. If you look at this, the correct answer is B, right? That is the one that addresses the market risk. Right. And question 4, B. Okay, let's go to question 5. Right, I've got 7 responses. Let's see the question. A perfectly negative correlation between two variables imply that on average they move in the same direction. On average they move the opposite direction. They always move in the opposite direction. They always move in the same direction. Yeah. So the answers given are correct. It is perfect negative. That means they always move in the opposite direction. The answer is C. Good. Let's go to the next question. Question number 6. Right, I've got 5 responses. 5 responses. Which one of the following is a method of calculating value at risk? VR. Historical simulation, negative correlation, sensitivity analysis, probability of distribution. Yes. Out of the 5, 4 people have given the correct answer. That is A. Seven. Next one. Right, I've got again 4 responses. Security A has a standard deviation return of 6% and a mean return of 10%, while security B has a standard deviation of return 10% and mean return of 12%. Assuming the returns are normally distributed, the riskier security is A because the mean is lower, A because the standard deviation is lower, B because the standard deviation is higher, B because the mean is higher. So what's the correct answer? B, the question is about the riskier, right? Riskier. Risk is given by the standard deviation. So it's B because the standard deviation is high. Question 7. Answer is C. Right. Question 8. And I've got 6 responses this time. Let's see what the question is. Market expectations of an increase in base rate have led to changes in the price of government and corporate bonds. This is most likely related to currency risk, liquidity risk, volatility risk, interest rate risk. Yes, the correct answer is interest rate risk. Most of you have given the correct answer. We do 2 more. That is D. Let's go to question number 9. Right. We have 5 responses. A bond holding is providing difficult to sell as there are insufficient buyers due to adverse market sentiments. This is an example which type of risk, right? Basis risk, interest rate risk, volatility risk, liquidity risk. We remember we discussed subcomponents of this risk. So not having adequate buyers is liquidity, right? Market is not liquid. So that is D. So most of you have given the correct answer. Question number 9, the correct answer is D. Let's do one more and finish, right? 10. Right. I got only 4 responses again. Right. Let's see. What difference would there be between the risk management function of a bank trading on its own account and those of an investment management firm? So when you outsource it to an investment management firm or a bank itself, the risk would be no difference. Can't be the case. The bank risk management approach would vary depending on the type of investment it was making, whereas the investment management companies would vary depending on the size of this investment. The bank's risk management approach would operate on a cross-the-board basis, whereas investment management companies would vary depending on the risk appetite of its funds. The bank's risk management approach would operate on a cross-the-board basis, whereas the investment management companies would vary depending on its size. This is an interesting thing if you can't remember. Here, the difference between a bank managing its risk versus a fund or investment management company managing its risk. So when an investment management company is managing the risk of an investment, what they do is they identify different portfolios, investment options, and let the parties, investors come and invest. And they have different types of investments. So each of these investments will have its own risk profile. And that's what the selling point for the investors. Depending on the risk, they have the returns as well. Therefore, unlike a bank, which manages its risk holistically from an overall point of view, that's why we talk about integrated risk. An investment management firm looks at risk individually for each of the investment, because each investment has a separate risk profile and different investment will invest in that. So that's the difference. So the correct answer therefore is C. Correct answer is C. Right. So we completed up to the 10th question. So with that, I stop for today. So we completed halfway through the market risk as well. And we will do the balance of the market risk and the rest of the areas in the next week. Good night.
Good night, sir.
Good night, sir.